First, we must set the foundation for how the market moves. The market, like you and me, isn't perfect. Some days we have really good days, and other days we have really bad days. When you're going through things, sometimes you would describe your life like it's going inside of an uptrend. It's making higher highs and higher lows. And other times, you would describe it like it's going in a downtrend, where everything is just stagnant. You got kicked out from work, you're getting bad grades in school, things are just happening left and right. Now, if I go onto the charts, we can see this right here. First, let's zoom in into when your life is going right. So in the market, you can see this on the charts. You're making higher highs each time and then higher lows. It's pretty simple when you really think about it. It means that people with more money than us are pushing the market higher at each of these spots. The overall trend is in an uptrend. And then at a certain point every time, the market switches. Some people call this a coach. I just say, okay, the market's going in a downtrend and is switching its direction. So here now, the market is making lower highs and lower lows. Lower low, lower low, lower low. If I put my candlesticks back on, we have higher highs, higher high, higher high, lower high, lower high. Like once you start to look at it more, you start to notice it more easily. Like you'll just look at a chart and be like, oh, okay, that's a higher high, or that's a higher low. Now, an easy way that I like to think about it, just like looking at price, let me go back to the lines. Let's say that we're at this point right here, and you're like, let me decide, where are we moving like? So I look at the point where the leg of this overall move started from. You can see where I already have my box right there. But where did the move start from? Started from right here. So remember, when we're going through life, when life is not going our way, we're making lower highs, lower lows, just like the market. If the market breaks above this leg right here, I consider us going inside of an uptrend again. Because for the market to be in a downtrend, we have to continue to make lower highs and lower lows. So if we break above this point, I say we're moving higher. Same thing when we're in an uptrend. Let's say that we're at this point right here, and the move started from down here. So if the market would have broke below this leg, I consider us in a downtrend now. We're switching. You can see it better up here when the market switched. Because what happened? Where did this move start from? You can say it started from right here. This was the last push of this higher high. And what did the market do? It came back and broke below this. At this point, I'm like, oh yeah, we're selling because we're breaking structure lower. Here's an example of this happening more real time. I have my back testing software I'm going to show you guys. So we just get into the day. We're looking at the charts. So at this point, what are we doing? This is the lowest point in the market. Where did the move start from? It started from right here. So we are selling. Let me go to another example. All right, right there, right there. Perfect example. Where's the lowest point in the market? Where did the move start from? Right here. What did we do? We broke above this move. We're going higher. To me, we are inside of an uptrend. It's something you just have to see more and more as you look at the markets. Now, going back to our example from earlier, we might have good days and bad days, but some days it feels like life is just in the middle. This is what we call a range. We're making equal highs and equal lows. We're basically not going anywhere. We're bouncing back up and back down at these points, and nothing is happening with price. Now, let me show you guys an example of this on GU right now, because GU is currently in a range. Now, this example looks basically exactly like my drawing. What is GU doing right now? It's like how we described with our lives when it's being stagnant. It's going back up and back down at these points. It's making no major movements inside of a trend. Like all this, it was trending before, but now it's moving back and forth between the same points. So for me, like I talked about, I mark off where the highs are, where the lows are, and if I see it happen 2 to 3, especially 4 times, I say, okay, we're inside of a range. The 4 hour time frame is where we mark up our overall structure. The 4 hour, where I have it right here, all a 4 hour means is that each candlestick took 4 hours to form. Some people say use multiple time frames, which means instead of just using the 4 hour, they might use the 1 hour and the 15 minute. And some people say just use one time frame, which means they probably just use one of these or another one. I would recommend just sticking to the 15-minute time frame or higher, not the 5 minute, not the 1 minute. If you're sticking to one time frame, 15-minute or higher. This because price movements on the lower time frames might be too much for you to handle when first starting out. Going over what we just talked about, we look at the 4 hour for our structure and we trade on the 15-minute or higher as our main time frame. Now, time frames are important, but also our sessions. We need to trade during the right sessions to catch more volume and better moves. There are 4 sessions in the Forex market. We have New York, we have London, we have Australia or Sydney or whatever you want to call that, and we have Tokyo. Now, me, since I live in the US, I primarily trade this system during New York or London session. New York session starts for me at 8:30 a.m. because I live in Central, and then London starts at around 2, but goes all the way to 11. So I would see where you live around the world. Try to use this system around one of these 2 sessions. Going back to our market structure example from earlier, let me go back to the charts. What do you think the best price action to trade along with this type of structure would be? There's so many that exist. You could do break and retest. You can do support and resistance. If you thought supply and demand, though, you were definitely correct. But you need to trade the more advanced supply and demand levels so you do not get wrecked by the markets. If you do not know what supply and demand is, first, let's go over what supply is. Now, if you look on the internet or anywhere else, a lot of people say supply and demand is this, supply is that, supply is this. Explain it in a complicated way, but today we're going to keep it extraordinarily simple. Supply is when we are in a downtrend, right? Making these lower highs and lower lows at a certain level, price sold off here. And what did those people with more power than us do? They came back to this level and sold off again. That's the basics of supply. Supply is when multiple sellers sell off at the same level where the position started from. Basic, basic. So let's go see this on the charts. There are so many examples of this happening. I see a good one right here. We were in a trend. We were moving lower. We were making lower highs and lower lows. And what happened? Price went down, came back to this level, and then sold off again. Let me do it on the 15-minute time frame, since that's the main time frame we trade off of. All right. If you can see it before I point it out, you're doing really, really well. Let's look at this level right here. So we were selling off lower highs, lower lows. Price broke another low, made a lower low right here. What did price do? It came back to the zone and then it sold off again. That's supply. That's the basics of supply. So if that's supply, what is demand? If you were thinking that demand is the opposite, you're entirely correct. Demand is when we're making higher highs, higher lows. And what does price do? If you can already see it, we come back to this level where we bought at, and then we go even further higher. Simple market structure. Don't overcomplicate it. Now, let me go to GU for this one. All right. So what did price do? We bought from this level. Price came back. The buyers were like, okay, let's buy again. And we started buying it yet again. This is demand. Simple. Now, you're probably thinking, how in the world do I know? Like, where do I draw my demand or supply zones at? Do I just draw them anywhere where there's multiple buying or selling candlesticks? No, you want to put your box. This is very important. Put your box at where the move started from. You could do 2 candlesticks, but normally I just do 1 for me. But you can do 2, like for this example. But you wanna put your box where the last selling or buying candlestick was at. So if you're looking at demand, draw your box around the last selling candlesticks. And opposite, if you want to look at supply, you draw your box around the last buying candlestick, which is right here. And this candlestick right here. You don't draw it just anywhere. You have to draw it where the moves start from. Another tip that I have is to remember to look at how many candlesticks as well. You don't want to trade just any supply and demand zone. We're going to get into that later. But you want to trade the ones where large candlesticks are coming out the zone, because that means there's a lot of buying. Like, see how many candlesticks came out of the zone? It means there's a lot of buying happening, and it's more likely that buying is going to occur again. Now, Like we were talking about earlier, you cannot trade any of the zones on the chart. You would be wanting to blow up your account if you want to do that. Think about it like this. You are a fisher. Every day you go to your lake to go catch some fish. Here's your little rod, here's your little fishing thing. Now, in one day, there are plenty of little fishes that come and go. Now, these little fishes, they can feed you a little, but once a day, there's this really huge fish and gives you food for the whole entire week. We have to use this same thinking when looking at supply and demand. The best zones are the fish that will feed us for the whole week. And an indication of a really good zone is a break of structure. Now, let me go back to my example here. We always go back to market structure. We said that a trend is like this and a downtrend is like this. So, what do you think a break of structure is? A break of structure is simply when, look, you drew this leg too high. Simply, price breaks above the previous high and goes back into our zone. Simple, 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 simple. So supply and demand zones with breaks of structures are better probability than other zones that don't have these breaks of structure. And let me go see a really good example. And then let me show you guys an example as well of zones that don't count as breaks of structure. Okay, let's say you're right here. You're selling off. Screw all this right price action over here. Let's say you're just looking at this supply zone. You're like, okay, this is a supply. Okay, but what didn't it do? It didn't break below this previous leg right here. It didn't break structure. It's a supply zone without a break of structure. So if you would have sold off right here, you would have thought you were okay. But look what happens next. Price blows through. Now, a really good example of a break of structure is right here. What did price do? Look closely. Price broke above all of this structure. All of these highs, price broke above it. Price comes back to the zone, starts moving higher. Let me look at a good one which follows the trend. All right, here. What did price do? Price broke below all this structure, all of it. Came back to the zone, sold off again. I hope you're understanding what we mean by a break of structure. Now, other than a break of structure, a huge key that I use that I credit to my guy Doyle Exchange is gaps. Gaps inside the market. So you might be thinking, what is the difference between gaps and just regular supply and demand zones? I'm going to explain this as simply as I can. So, as we said earlier, the market moves from lower high, lower low, lower high with these supply and demand zones. But a gap with the supply or demand zone is higher probability than just some regular supply and demand zone. So a gap is exactly this. We saw right here that we had a supply zone, but what do you notice the difference? This supply zone. There's a gap. This is area that price has to come back and fill. And usually when price comes back and fill these gaps, they're more likely to sell. I'm not saying it does it every time because it doesn't, but it's more likely to occur. So for you to see it better, here's another supply zone. Look at this supply zone and then look at this supply zone. Inside of this supply zone, this wouldn't be a gap for me because what happened? Where we draw our box at, price already wicks out the box. So that's not a gap. A gap for me is when the next candlestick doesn't even touch the box at all. Here's another example. But this didn't really have a break of structure, so I would not be looking at this. But it did have a gap. The gap was right here. Price came back, filled in the gap, and started selling. Here's another example. Even though price didn't sell too much, we broke structure and we had a gap. The gap being right here. So we broke structure. This is the gap. We have all this movement. The next candlestick didn't even touch back into the box. We come back, fill it in, and start selling. Here's another example of gaps. So what do we have right here? We have both a break of structure and then we have a gap with the supply and demand as well. Price comes back into the zone, starts selling off. You guys still don't understand it? I could make a whole video on fair value gaps because I used to just trade gaps, but then I implemented supply and demand as well. And man, now we identified the best supply and demand zones. We know what market structure is simply, but we're missing one key piece. We need a way to enter the market. Think about it like this. Imagine you are trading and a supply and demand zone comes up. You think it's a valid signal and just get inside the trade. All of a sudden, price rips through the zone. You are missing an important element inside of the entire process. The way I achieve my trade entries is by a break of the candlestick. You can call that whatever you want. It's so many terms, but I just look for one candlestick being fully going lower and engulfing the next one. And I get in when price breaks that other candlestick. Very simple. Let's go to an example. All right, so we go here. What do we have? We have our supply zone with the gap. We have that break of structure we were talking about. It broke below all the structure. And then let's zoom in. So where did price break the candlestick? It broke the candlestick right here. I'm putting my stop loss right above this high and I'm getting in right there. And I'm aiming for whatever. I'll get into risk management soon, but you aim for whatever. But I make sure to get in at that break of the candlestick. Now, with break of this candlestick, it has its upsides and its downsides. Just because everything is printed already for price, because this is not the live market right now. This is basically old data. But sometimes price can break your candlestick and then reverse and go straight for your stop loss. It's happened to me a couple of times, more times than I can even count. That is somewhere where I would just get out the trade because more than likely you're gonna lose. It happens sometimes. Now let's go to another example with break of the candlestick. I think we would have lost on this one, but I don't really trade during these times. We get in, we have what? We have our supply zone. If you look really closely, we have that gap, comes back, touches the zone. We get in, break of the candlestick, which is right there. Get in, aim for that one to whatever you want to aim. One crucial element though, even though I'm just showing examples, we only trade New York or London for this system. Now, if you find success in other sessions, go ahead because you can see supply and demand everywhere just like I'm showing. Now, other than break of the candlestick, we also have another entry, which is aggressive entries. So instead of waiting for that break of the candlestick, all you would do is when price comes back to your zone, you would just sell right here. Once price starts to, wick a little, you get in right here and you aim down. Now you're probably thinking in your mind, dang, I could get a really nice risk to reward with that, or I could get lots of pips with that, or I could get a lot of a big move with that. The only problem with getting an aggressive is if you don't have experience, you're not gonna get in properly because like I said, this is when the market isn't active. Sometimes price might come back to your zone and not respect at all. You might think it should be an aggressive entry, but price will come back and take you right out because the candlestick isn't all the way printed. We're looking at the candlesticks right now as they're finally done, but candlesticks, as you know, move up and down before their final printing. Now, we've gone over the best zones and best times to trade supply and demand, but when shouldn't we be trading supply and demand? So, like we said earlier, we always go back to structure because structure is like the foundation. You know, that price goes higher and lower. When do you think supply and demand doesn't really work too well? Is what we talked about when price is just going up and down. When price is sideways, we do not trade supply and demand. And if you remember from earlier, we look at our structure on the 4 hour always. So inside of a market like this, I'm not trading at all. This market condition, from what I've seen, is not the best for supply and demand, especially when you're trying to catch. If you're just trying to catch small moves, it's fine. But if you're trying to catch big moves, it's not the best. Supply and demand works better, doesn't work perfectly, but it works better when we are making these lower highs, lower lows, or higher highs, higher lows, which makes sense because we're moving inside of a trend. Another time I don't trade supply and demand is when it's just one candlestick. I don't like these small candlesticks of supply and demand. I like when price forms more than one, like we talked about earlier. For me, I have an at least 2 to 3 rule. Has to be at least one of those. If it's not, I am not trading supply and demand. And the last time we don't trade supply and demand is what? You can probably guess it. It's news. We're not touching the market when there's news just coming out. If there's news that comes out, right, and it touches your zone and it breaks candlestick, do not get in. Honestly. The broker shouldn't even let you get inside the market when that happens. Because news is volatile, it's unpredicted, it's all these other things. But for me, honestly, some people take their stuff out when there is news. I just keep my position open because I have found that it doesn't really hurt. So if you're already inside of a trade from our earlier supply and demand and news happens, you can honestly just keep your trade open. All right. Let's talk about risk management and risk to reward. So, if you've scrolled on YouTube, you've heard probably so much about risk management. So, if you don't know, risk management, all that means is only risking a certain amount of capital per trade. Per each time you see this supply and demand system or entry or whatever come up, you only risk a certain percent. For us, I like to keep it to 1 to 2. That's how much we risk. Now, that's our risk. The other part of risk management is reward. Now, if you've been around the trading community or you seen what I did earlier with the risk management tool, you saw how I said 1 to 1, 1 to 3, 1 to whatever. This is reward. So, as you can see, we're risking 1 to 2%. So, what do you think reward is? A 1 to 1, all that it means is that you risked 1% and you made 1% back. A 1 to 2 means you risked 1%, made 2% back. Nice. A 1 to 3 means you risked 1%, made 3% back. The only and the last part of all this, I almost forgot, is your win rate. And you're probably thinking, how does win rate come into risk management? Win rate is important because you might have a 1 to 1 and be hitting 60%. Same strategy, same system. 1 to 2, you're now hitting 50% or 40, high 40s. 1 to 3, you're now in the low 40s. So win rate is very important. But this whole thing, this whole risk management thing doesn't matter if you don't define your edge, which is why we went into the supply and demand strategy earlier in system. Now for me, I go for a 1 to 3 on each trade. I see that it works best for me, and I don't really care if I'm getting a lot of losses. I know I like big winners. And honestly, I win 40% of the time over a large number of trades. I can make a whole risk management guide in another video. I risk 1 to 2%, go for a 1 for 3 on each trade, and I win 40% of the time over a large number. I can be losing in the short term, but I know over the long term is 40 to even 45%. So let's go on the charts and look at this. We have our supply zone. We have our break of the candlestick. The market broke structure, came back to the zone, and that's where I go for. That's where you can go either for a 1 to 1, 1 to 2, or 1 to 3. Simple as that. Now, one extra bonus part I like to add to supply and demand is what pairs are you trading on? For this system, normally just look at GU and AU. And with GU and AU, what do you notice? What do you notice? What do you notice about the currencies? They're all correlated with the dollar. So as a as an important piece to our overall market structure and our direction or whatever, is looking how the dollar is doing overall. It's very important because if the dollar is primarily buying right now, why would you be buying another pair like odd USD when you know the dollar is stronger at that too? Just basic fundamentals, basic economics. That's another thing you can look at when looking at the overall system. Now, my last point I'm gonna share with you guys is a little bit of advanced market structure that I like to use now. Everything correlates back to market structure. So we said that we trade our market structure on the higher time frame. This is call this our 4-hour time frame. Let's say we are in this area right here, that area right there. We go on to our 15-minute, which is our main time frame. What do you think price looks like? It looks more like a more smaller version of this. So when do you think inside of this whole thing would be the best time to trade? Where you're in line with the 4-hour. It would definitely be somewhere right there. Because if you can see, this is our leg, it's our push, which is right here. This is our pullback, which is right here. It's not a good time to trade because we are pulling back. And then this is our push higher, which is the best time to get in because we are breaking above, the 4-hour major structure, which is right here. We look at this on the charts. You're not going to be perfect with this at all, honestly. But it's just something to look at when you're looking at supply and demand. So, current market, right? We're selling off. We're on the 4-hour. We made this low. The move started from up here. Now, what do we have right here? We had a pullback, a very good pullback. This whole thing right here is a pullback. So when would be the best time to get into price? When price makes that break, when price breaks below, and then we start going lower. This is not really with our supply and demand from earlier. It's just identifying the more advanced, so you know where you are with the market structure, and you know when your trades are just a little bit less probability. Because if you know where you're at inside the market, it'll give you a little bit more clarity. But the best time to get into the market is when price changes. Make some type of change and signals that we are going lower. Because more than likely, we're going to take out this low right here. All right, putting this all together, we're going to go through a couple backtest examples so I can show you guys exactly how to put all of what we talked about today together into practice. This is my backtesting software, FX Replay. First thing I like to do is going all the way to Tuesday. All right. So first thing I do, like always, look at the higher time frame structure. Where's the lowest point in the market? It's right here. Where did the move start from? Up here. As long as we don't break from up there, good. Scroll down to the 15-minute. Looking for gaps. This gap right here already got filled, but it's not during my session, so I wouldn't have taken that. Keep on looking. It's 9:30. I'm done for the day. The market didn't present anything, so I'm done for the day and I'm going to the next day. I do the same thing. I'm looking at structure, paying attention to what price is doing. This setup broke above this structure right here. It didn't break above here, which is kind of make me a little iffy, but it did break above this little support or this little break right here. So what am I doing? getting in if it breaks candlestick. And it doesn't, it folds. See what GU is doing. Okay. You also got it set up on GU. Let's make this bigger so you guys can see. We had this demand from all the way over here. Go to the 4 hour. Everything is looking cool. We're breaking structure higher. You see this, you get in. If it breaks candlestick, go for your risk to reward, whether it be a 1 to 2, a 1 to 1, whatever. I'm just gonna look if it goes for a 1 to 2. And let's see what happens. We skyrocket up. So guys, this is why I go for higher risk to rewards with these type of trades, because you saw how I was looking for a setup for God knows how long. But let's go back to here and let's analyze it a little bit more. Because this is what every setup is gonna look like that you should follow. All right, so what do we have here? We have demand. Like we talked about, more than 2 candlesticks. It's breaking structure higher. Ah, my bad, guys. It's breaking structure higher. Broke above this point. Breaking all types of structure. I think it's also breaking above structure. You can't see it because of my chart, but it's breaking above here as well. This point broke above all this structure over here. And it's coming back. So then it comes back to the zone. You get in at that break of the candlestick, put your stop loss right under, and then you aim for whatever you want to aim for. Well, the market structure was bullish. We were in a range, but then we broke out and we're bullish. So I just wanted to show you guys my results from doing this like 100 times. I have other back tested sessions. I've back tested a lot, a lot. So with this system, my average win rate 46%, and I'm doing everything correct. I took a total of 163 trades. My max losing streak is 11. So that's what I told you guys with that R and R. Is the higher you go, the lower you go with your R and the more 1 to 3, 1 to 4 you're trying to get, the more losers you're gonna take. Max win streak is 6. I couldn't believe that was a really good win streak. And then these are my percentages year by year. Nothing crazy at all. I feel like the 2018 is probably like an average year. And 2020 was a weird year because, if you think back to 2020, what was the market doing? It was really easier to make money. So these are average. It's an average performance. And each month I'm averaging around like 2 to 3%, except for some months where I get like crazy 12% or 7%. But most months is like 3%, 4%, 2%, -1%, sometimes -3%. If we're talking about November, December, maybe August, even August is okay. And sometimes I don't make anything. So this is just that. But other than that, I wanted to give you guys a custom made trading plan to follow, just in case you guys forgot or forget the steps on how to find these supply and demand zones. So I made this little custom made trading plan. It's not the best looking, but it's just a Google Doc form. The link is in the description if you want to download it. We talked a lot about systems today, but the best system in trading is your mindset. If you want a way to be able to conquer your mind, watch my video. Your trading psychology is keeping you broke.